Hey.
Dante, you there?
I am here.
All right, there you go. You kept me nervous there for a moment.
Technology is amazing.
My first show of the week, and you weren't around. So I was a little scared.
I should have, I call myself talking to you guys and like, hello, and realized I was not on stage. So welcome. welcome.
Glad you're figuring that stuff out.
Hey, man, that's what the mortgage business can do to you sometimes. You think you're sharp, you're on point, and you're all over the place. So
yeah, just stick to writing loans. Don't worry about technology, right?
Technology is amazing, man. It is simply amazing. But welcome, one and all, Epic Lunch and Learn. I am your host, Dante Royster, mortgage broker, author, and your guide through the maze of money, markets, and mindset. And what a week we've had. We've had a great week. Started off with Ari Rastegar. Thank you so much for being on. Hope everyone liked that. Make sure you check out. That was episode 50. And then we had L'Oreal Flowers. We had a listing agent, really going over strategies and things to do around the winter season as the temperatures dropping this weekend in the Midwest. That's what I heard. So I'm like,
let's keep that as fake news.
Man, I think it's real news because I'm looking at it because I'm going to be at the Bears game.
Yeah, I was just going to say that. Didn't you go into another Bears game?
I'm going to the Bears game. I'm like, dang, 37 degrees in the cold. Yeah. This ain't Detroit, Jess. This ain't where you're indoors.
Yeah, it's nothing like Ford Field.
No.
Yeah, man, can you imagine that, watching a Bears game at 70 degrees?
Man, that would be amazing. Well, it's supposed to be happening pretty soon.
Yeah, we'll see how that goes.
They're still trying to negotiate that.
Remember, go to Home Depot and go buy those hand and sock warmers and stick them in your toes.
Man, yeah, I gotta be ready to go. So,
and don't get me wrong to the audience, 35 isn't that bad for a Bears game. We've all been through worse, but it's still comfortable to keep your feet warm.
First and foremost, if people know who I am, I don't like the cold. I don't know why I'm still here.
Why do you live there?
Why? 20 years ago, my mom told me when I was like 23, 24 years old, she's like, this is your moment right now. Move. And I was going to transfer to a mortgage company out in Oakland. I was going to move out to Oakland, California. True story. And I was like, but I had a girlfriend. I was like, oh no, I can't leave. Let me stay. Man, got me in this cold weather. Now I'm stuck.
In the meantime, she left him and went to Oakland. No, kidding.
No, I think she's my wife. But anyway, it's crazy.
Okay,
but yeah, crazy story. But yeah, I stuck around. Should have left. I should have. But no, we're here now. And today, what are we talking about today? Today, we are talking about the federal funds rate, because this still annoys me, Vince, and just this does annoy me that a lot of people just don't understand, what you hear on the news versus what is reality, and don't really, and once again, the media and just the marketing capability, the advertisement that they do, they really sell on fear, and that's what fear motivates you to turn on the news and see what's going to happen. But the reality is, we have to start doing our own research. I made a comment yesterday when I was talking to L'Oreal. I talked about how, when I went to school in college and I graduated, I was like, yes, it's over. I don't have to study anymore. I don't have to read anymore.
Just begun, right?
Yeah. And what really is college is that really that playground that allows you to start learning how to self-study and self-motivate and really educate you so you can do this moving forward in the future. I didn't realize that. I was just a nerdy jock, just like, man, no more English class. Great. And little did I know. But needless to say, why don't we start talking about the Fed funds rate and just the love-hate relationship towards the mortgage market? Jess, you want to kick that off?
Ooh, the Fed funds rate. Oh, I don't know. I have so much ranting to do with this, but we have so many good things to talk about. Um, Vince, are you experiencing your borrowers listening to the news more than you? Are they, that is, oh, and you're listening to them and you know they're oh so wrong and you want to help them, but the news is telling them every day that mortgage rates are going to come. They're actually, that's the problem. It doesn't even say mortgage rates. They just say rates. And that's where people get confused.
Correct.
That's been your experience too?
Yeah, I mean, the
Yeah.
loan we just closed yesterday, the guy called me up on Monday. Well, after the Fed meeting, he's like, I get a lower rate now. I'm like, whoa, whoa, whoa. We're like 2 days from closing. We've been locked in for 30 days. All the numbers are what they are. We're going to move on. It doesn't work like that. And at the end of the day, what are we talking about? 20, 30 bucks?
Right.
And that's the whole point of why we do this too, right? It's to educate, because it's not just about what you hear. It's about what you need.
Absolutely. Exactly. Absolutely. And we are not order takers by any means. Like, we try to educate our clients. I unfortunately have had quite a few people have this. It's not even an argument, because it's a discussion and they don't really know that they don't know what they're talking about. But I'm finding that a lot of people still want to be sold a dream, and being sold that dream is really screwing up their financial futures and the dreams that they should have. I've been running into clients just in, well, let's say the last maybe 3 weeks ago, right? When things were really good, back in September when things were really good. I have borrowers that miss opportunities to save 300, 400, 578. I know that's a very specific number, but it bugged me. $578 a month. But they're, no, the rates are going to go down more. That's not, that does not mean what you think it means. So
Yep.
let's talk about it. And they're just still not convinced because, like Dante said, they're selling fear. And the news outlets know exactly what they're doing.
Yeah, absolutely. Right.
Because words matter.
At
Words
the end of the
matter.
day, we've said this over and over since we started this. Rates are still going to come down. There's a little bit of a pause. They're going to go up and down. They're going to fluctuate, but there's opportunity for clients to save, like you said, $500 a month, right? And that's the time where you have to strike and you have to do it. And then you just have to suffer whatever happens after. If they go lower, come back to us. We'll do it again if it makes sense, right? We've talked about this. We're in that period of the time where Dante labeled it as you're getting a twofer. You buy the house today, you know the rates are going to be lower 6 months to a year from now. It's the same thing when you're taking cash out and you're consolidating debt. And granted, we don't want to get specific into that. There's what we call pricing adjustments when you take cash out of your home. They charge you more money to do it. So if you do it now and rates come down later and you don't need to take the cash out later, you'll get a better rate. But when you're saving someone $500 a month and they still don't want to take that transaction, the question there is, what are they doing, right? Because that 500 is serious, right? It can go into your 401k.
Oh, yeah.
It can go to change the term. Instead of doing a 30-year, maybe you do a 20-year, and it's the same payment. There's so many advantages there.
Yeah. Last night, to you guys' point, client on the phone called me back after a year. I hadn't talked to him for a year. Called me back, said, "Hey, and love the client. And I think if he's listening, I love you. The type of client that'll call you 4 or 5 times. What you got? What you got? What you got? Like, hey, give me a second. Let me sit down. Let me really prepare. So, we're on the phone last night and we're crunching the numbers, and basically he's paying about $2,090, right? So $2,090 a month. And he's been in a townhome for the last 3 years. So he's got 27 years left on the mortgage. All right. So, he wants to lower interest rates. So we were working out the numbers and we came down to 2 different proposals. I said, hey, we can virtually keep your payment the same, but drop you to a 20-year, 20-year in the 5s.
Yeah.
Or if you want, I can go back to 30 years, depending on the nature of the person, and you could save $273 a month. And, he was struggling with the idea and the conversation of like, well, what do you think rates are going to do? Where's your crystal ball at, Dante? Tell me where rates going to go. Should I do it now or should I wait? And that's a discussion I think millions of people are trying to have that conversation on, especially that have bought, virtually from, somewhere in 2022, mid
Mhm.
to end of the year 22 to present. Hey, I know I have a high rate. I hear rates are going down. Should I lock in now and take advantage of it, or should I hold off? Because for this gentleman, and for some out there, $273 doesn't necessarily move the needle. It's a nice savings,
Mhm.
but he doesn't really know. And that's the thing that I think we kind of have to talk about. We have to kind of create that vision board of what can that 273 do. So a lot of people, I feel like when they're stuck, is they don't envision what that 273 can do. Now, if you have credit card debt and you're struggling, financially, it's hard to breathe because bills are just piling up. Of course, it's a no-brainer. Hey, I can save you $273. Case closed. We had a client close on Monday. A repeat client came back, and we're saving them $200 a month. It's a no-brainer. They close, all as well. But for others that are in maybe a better financial situation, 273 sounds good, but it doesn't really like motivate them to get off the chair or off the couch. And so now we have to kind of say, what can that 273 really do for you? And so that's where, the job is on us to really, make sure that we're, knowing our clients, right? When we're talking to them, we have a little bit of a relationship, because, he just couldn't fathom, like, should I pull the trigger now? Should I wait? What do you think I should do?
That has been a huge issue. And you're right, like painting the picture, selling on the emotion, right? Because I know what I would do with 3,276 extra dollars a year, right?
Sure.
And even if it doesn't matter in that moment and they're not feeling the pressure, I bet there's something fun or some kind of hobby that you can refinance and take that 3 grand and spend it on that. Do whatever you want with it, but take the savings while the opportunity is there.
I,
Correct.
I got it. Granted, not knocking the client, and we always want to present options, right?
Correct.
In that option, especially being a previous client, there is no other option. If you would have just gave him a 20-year option and said that your payment stays the same, from a sales side, he'd probably lean into that harder, right? Because they don't see, I don't mean they, clients don't see that long-term savings. But just think about that. You took him down to a 20-year mortgage without any change in his budget.
Huge.
Right? But yet you gave him a choice to say, hey, you could save $250 a month. And
Because
that's
he
sometimes
didn't,
when
yeah,
we present too much information.
He didn't flinch. Yeah. Yeah.
Right?
It didn't motivate him. Like, I mean, obviously it's over the phone. And so, when we're talking to people over the phone, or even if we're doing a Zoom, he was stoic. It didn't move him that, hey, my payment can stay the same, but I can save the 7 years of interest. Now, obviously, if I had those two choices, I'm choosing that all day long. I want to cut the term as much as possible. I was like, hey, now, remember, when you take out a 30-year mortgage, that's 360 payments you're agreeing to, right? So if you've paid 3 years, and I was breaking this down, that's 36 months you've paid, so he closed December 2022. And I'm like, okay, so 36 months, so 360 minus 36. All right, so you have 324 months of payments that you're obligated to make. I'm going to take it from 324 to 240.
With no change.
No change.
No change.
And
right?
And
instead of you getting $250 a month off of your principal, you're now getting $700 a month off of your principal.
Correct.
Right? And you're gaining that much more equity. And in 5 years from now, when you're now 8 years into that house and you say, I need a bigger place, I want a single family house, you have probably a third more equity than if you would have stayed in the current position. Right?
Correct.
And that's the whole thing, right? Like, and again, don't want to say it, right? We're great to advise. We like to present options.
Sure.
It's what we're supposed to do in today's market, right?
Correct.
But sometimes we give too much information and it's like, here's what you should do. No other questions asked. This is it, right? This is your best financial position. And it's just, we don't have opportunities like that anymore. Like we did in 20 and 21. Like, here, let me take you down to this and this, and you're paying the same amount of money. But the atmosphere was so much different then in those years that everybody was doing that and rates were so lower. You're doing it now, even in a higher rate market. And unfortunately, hopefully the client's listening and he calls you back. And to the client, please don't take anything I'm saying to be negative. It's about, if nothing else was said and you were given the choice of, hey, let's knock 7 years off, you would say yes.
Mm-hmm. I mean, the thing is, for consumers, when you don't know this world, when you don't know this industry, right? We're the professionals, right? We've put the 10,000 hours in. You're leaning on friends, families, and neighbors that you talk to. Right. And their situation is different from your situation. But still, you're listening to them saying, oh, I saved money on my mortgage when I refinance. I saved money, or I got cash out. That's what you're hearing as a, answer of, here's the solution. If I do this, these are two. So when I say, hey, you're not going to save any money, but I'm just going to cut term, it was almost like, I was speaking a different language. Like, what?
Right.
No. How about, how much can I save money? And then now I got to go back to a 30-year, which I'm like, okay. But, once again, I need to know more about you. Like, and then I start probing. I was like, okay, you must not be a Dave Ramsey fan, right? That was my interlude. Oh, you must not be a Dave Ramsey fan, right? Because I'm trying to cut term, man. I'm trying to get you to 15 years, but okay, we can go back to a 30-year. That's fine. Now, how long are you trying to stay in this property? I mean, is this a life? And all his answers were to choose option A. Option A was everything he said, but it's just like his mind could not get to that concept. So, but
I'm
yeah,
curious. What age range was this human?
What was this human? I would tell you this human, I don't know off the top of the dome, but I would say mid-50s. Oh yeah.
Oh, that's different. Okay, I was thinking you were gonna say like 30s, 40s, and they're out there, just rolling the dice, which I don't understand. And I guess maybe I need to talk to more people of that generation that are homeowners.
You got two of us sitting right here, relatively.
Well, but you guys, your mind.
We're here.
I know how you guys.
We're knocking on those doors. I'm hitting the 48 next week, so I'll tell you what 50 feels like in a couple years.
You guys know how to look at it, but I'm finding, like, I have a client that I've worked with quite a few times. And I could have saved her $360 a month. And at the time, I also could have paid all of her closing cost. But listening to the news, she wanted to wait and see if rates went down. And I tried to have that conversation if it's not the same thing. And then the appraisal scared her. But even though her equity is just like the homes in our area are selling like hotcakes and the value's just going up. And I understand the fear thing, but 360 just wasn't enough, which it really blew my mind because she's on a fixed income. I don't understand the people on fixed incomes. And like, I really want to dig into it. And maybe it is just a fear. It could totally be a fear.
Yeah, it's on a fixed income, that's called a pay raise.
Right.
Right? On a fixed income, that's called a pay raise. There ain't nothing else to say to that one. I want to touch one other thing on rates. I know we hit a little bit. If you bought your house in 22 until now, you're sitting at a 7.25% interest rate. Sorry. It's time to prepare to refi. It doesn't mean you need to. You need to get the paperwork to your loan professional, get it in the system, and get it right, and get it ready to lock. Right? And we could sit here and say we see rates every day. You as the consumer don't. And when the market moves the wrong way, it's a missed opportunity. And you can go look at wherever you want. If you can save a point on your interest rate, no matter what it is, you can go back 10 years, 15 years, you're supposed to refi. Forget about anything else. You're supposed to change the terms of your loan. So,
you can actually look that up on ChatGPT.
That's correct, right? Everyone
that's
knows
what
that.
everybody believes now.
I didn't want to say that. You can go to the encyclopedia, okay?
It'll tell you 1%.
Correct. You get into the 1% of changing your interest rate, you do it, right?
Correct.
There's costs associated with anything you do. When we conduct the rate and term refinance, which is not taking cash out, which is just consolidating and lowering the mortgage payment, when we structure loans and we structure them correctly, you can avoid 1 month of your mortgage payment legally, because you would pay the 1 month forward. You pay in the first month of the new loan. You technically could save 2, and we can always get the loan done for what would be your 1 month mortgage payment. So if you turn around and say, hey, I pay $2,200, Jess, here's $2,200 towards my closing costs. What can you do for me? And you'll get the best potential rate with minimal cost, and you'll be able to take advantage of that. And I'm speaking that in general terms. It doesn't mean if it's us or whoever, it's your mom, your dad, your grandparents, whatever it is. If you know you can save a point on the interest rate, you're supposed to do the transaction.
The one thing I love that you said in there, and everything you said was factual and correct, preparing and having the strategy to already have the file submitted, because little do they know, it's like it doesn't just work. Like, you can't call me today and say, Dante, lock in today. I still have to register the file. I still have to get it through all these little mechanisms, that guardrails. So there's a point of, I could miss the opportunity if you're not already engaged with working with me.
Yes.
So that's the thing, where it's like the realization that, hey, the market goes up and down every day based on the news. And when we see an opportunity, we want to lock in. Obviously rates were lower last Tuesday compared to where they are today.
Correct.
And there was there's knee-jerk reactions that happen in the stock market, and then it affects us. So case in point, last Wednesday, right? The Fed come out, they'd say, hey, we're going to cut quarter point off. Yay, they're going to cut quarter point off. So everyone's mind says like, oh, I saw rates drop. But little do
Santa's
you know,
box is going to stay wrapped until January, right?
Well,
I mean, it's exactly what they said, right? Because we don't have numbers, or we don't have
enough data,
right?
And he was he was the Grinch. Jerome Powell
and again,
came out.
We said this a couple weeks ago. Even when the shutdown's over, the numbers are going to lag. So in not having the statistical information doesn't matter, right? And if rates don't get cut in December, they're going to get cut in January. And then as Powell gets closer and closer to being replaced, rates are going to come down even more, right? It's just going to be the pattern of what's going to go on. We're not getting down to under 5. Let's just remember.
No, and
right?
that's the same thing I keep telling people, because the 2s and the 3s, those were an anomaly that actually lasted longer than it should have.
Longer.
Absolutely, right? Right. But then again, we wrote business in those years to not write business in the 24 and 25 and whichever, right? Because that's what caused the things to happen. Right. But at the end of the day, and I'll say this over and over, and we can check Ramsey. You can look up Barry Habib, MBS Highway, 5.5, 5.75. If we get anywhere close to that at any point in time in 2026, that's a fantastic rate. And if you're at 6, is that really that much of a difference? Are you really going to wait to save a quarter of a point?
Correct. And that's what I told the guy last night. I said, well, hey, you want my forecast? Here's my forecast. Rates are where they are right now. They're going to kind of tread water until the government shutdown is officially done. And once the government shutdown is officially done and all this backlogged reports are going to come out, you're going to see a knee-jerk reaction where rates are going to go back up again. Because it's going to be like, oh, well, I got to look at this, and oh, I got to look at that, and oh, it's not as good as and so you're going to see rates go up, and then Jerome Powell's going to be gone, May 2026, his last month.
I want to see the replay. Can you go back? You were kind of moving your hands at the same time.
It was great, wasn't it?
Like a little juggling act there. I know Jess caught it, and I was like, oh yeah, I got to say something.
So, but that's what's going to happen. It's like, I don't have to be an economist. I don't have to, it's the soap opera of how we do our thing. And it's what I've seen over 20 years. And it's just what it is. So I said, reality is I'm probably going to be offering the same rates today in October of 2026.
Yeah.
That's the reality. It's going to just go in a circle and get right back to here. So let's just make the move now, take advantage of what's here. And then we can always reevaluate in 6 months, 6 to 8 months from now, and reevaluate.
Yep. And we
Guys,
said this earlier. If you're looking to pay debt off, you want to do it now, not wait for later. So then when rates do actually come down, you could do it again and get a better rate.
absolutely.
So let's do this. The federal funds rate is the
boy.
overnight lending rate between banks. Okay, it is
Between banks.
between banks.
Let's emphasize on that. Between
Yes.
banks. And in a kidding manner. Consumers, this is not the rate you have access to. Go ahead.
Correct.
And
Correct.
banks and lenders are not the same thing. That is not a commonly known thing that I'm learning.
You want to go deeper on that?
Let's just gump it down and say that lenders focus solely on mortgages. It can be one type of mortgage, it can be all types of mortgages, different products. Banks, however, they're where you can do a mortgage, but you're also holding your checking and your savings and your CDs. Banks are like an Applebee's, where lenders are more like a steakhouse. We focus on one thing.
Yeah, the federal funds rate is roughly about 3.875 right now. You know,
And that's
interest
what people think they're going to get for a mortgage.
correct.
And that's just not the same.
No, it's not the same. Generally, you'll always see 2 to 3% higher than what that's what you're going to see the gap. The gap is always about 2 to 3% higher than the Fed funds rate. So, right now it's roughly about what, six and a quarter, you can say, 6.25 on an interest rate, depending on a multitude of things, but just to have an idea of just the difference between the Fed funds rate and an actual interest rate just in the current market. So you have to understand that now it does affect credit cards, car loans, student loans, HELOCs. Those will be affected by the federal funds rate directly, but mortgages are indirectly. We're going to go based on the market. We're going to go based on anticipation. We want to know before it happens. We're greedy in that nature. So we want to have the ability to, anticipate. So we knew the Fed were going to cut a quarter point already. We already had that baked in. That's where we saw a huge influx, with the rates dropping, you saw an influx in mortgage applications. Everything was moving before the Fed even met. So basically mid-September through mid-October, you saw an increase, definitely more pickup, more conversation. And now everyone's finally, the people that are like, oh, I guess I should call. You kind of missed the boat on the sharpest pricing. It's still good, but it's not as good as it was.
Dante, I want to drop in so for everyone that's watching that doesn't understand the financial verbiage, I want to explain to you that mortgage rates are strongly tied to the bond market. If you don't know what the bond market is, it's easily Google, write it down, bond market. So the bond market specifically the yield of the 10-year US Treasury note. If you don't know what the yield of the 10-year US Treasury note is, you don't do this every day. That's fine. Look it up. Google, Yahoo Finance, Investopedia. Those are all great resources. It's really hard to understand how the numbers work if you don't know what the words mean. So go back to where you in second and third grade and you asked your parents what a word meant and they said, go get a dictionary. Same thing. Go look it up. You don't even have to flip through pages. You carry a computer in your pocket. But for you to have a better understanding of what's being spoken about, you have to look up the words that you're not sure about and the phrases you're not sure about.
Awesome. Yeah. It's like a Schoolhouse Rocks for mortgages.
Absolutely. 10-year Treasury. We've said it over and over and over again. When it's under 4%, rates will be lower. And if it's over 4%, rates will be higher. But either way, like Dante just mentioned, 30-year fixed rate mortgage between 6.25%, 6.5%. Current 10-year is at 4.1%. That's a 2.5 point margin. If you
don't know what your margin is, look that up too.
Yeah, there you go. And basically, that is the spread between what is on the 10-year to what the actual rate is, right? And so wondering what's my rate, what's a good rate, use that as a baseline to make your own decision. The 10-year plus 2.5. As we get into 2026, that margin or that spread will become lower and lower as they continue to drop rates.
Yeah.
I think people don't know that mortgages compete directly with bonds. And I think that's where a lot of confusion comes in too, just not knowing the basics of how the market works.
Yeah. I mean, that may be a little bit of a different conversation, the secondary market of the mortgage-backed securities versus actual treasuries.
Right. It's just not all the same thing.
Correct.
It's just important to know that you have to focus on your individual. I think we rely too heavily on what friends, family, and neighbors are doing, and not your overall individual situation. And they tend to not want to make a mistake, right? I mean, that's usually the thing, right? No one wants to make a mistake, but in these course of doing business, there's really not a mistake that's going to be made. It's just a choice, and it's an adventure book, right? Choose
your own adventure.
Choose your own adventure. You're going to go to page 32, because you went this direction, or you're going to go to page 67, to enjoy the journey. So, I mean, it really is your journey. We're just giving you information. And I mean, to the client last night, I don't really care if you go with the 20-year or the 30-year. I just want to help you get there. I prefer that you do the 20-year. It makes the most sense to me. But, I'm not walking in your life every day. And, and candidly, with a credit report, I can see some basic stuff, but I don't live your life. I don't know, your Netflix bill, or, what birthday parties you have to go to and how much money you have to spend. So there's things that I don't know unless you share them with me. So I can only give you, hey, these are the options. And then you got to choose what's best for you. And then, just to your point with that adventure book, you're just going to go to page 64.
Speaking about books, we're at the 32-minute marker. So why don't
About
we
that
turn
time,
this over
buddy.
to you for some house cleaning notes? And I know we got a new listing out in Texas that I'm sure you're going to be talking about today, and I'll let you get to it.
Yes, it's housekeeping notes. Housekeeping notes time. This episode today is sponsored by Epic Mortgage. Whether you're buying, investing, or refinancing, call Epic today, 708-905-5300. That's 708-905-5300. It's your dreams, your goals. Let's plan together. Now, what Vince is talking about, if you need a step-by-step playbook, a book that's going to help you, turn that house into a wealth building machine, is right behind me, off the left shoulder of me, The Ultimate Mortgage Guide. It is available on Amazon. Check it out. It's a good read, and it will help you. If you need a blueprint, it will help you. Now, after the show, if you are on LinkedIn, if you are on Facebook, you need to go to our YouTube channel, which is Epic Spotlight on YouTube. You need to check out the most recent podcast episode. We had the privilege of interviewing Sean D. Nelson. He's a visionary founder of the CEO and CEO of Lovesac. You guys know Lovesac?
It's the couches where you can interlock them, move them around.
Yes, it's
kind of like interest rates.
Yes, there you go. There's the connection. So I had the opportunity to interview the CEO of Lovesac, Sean D. Nelson. Discover how Sean went from making giant beanbags in his parents' basement to leading a billion-dollar public company. In this episode, Sean shares hard-earned lessons from his 25-year journey, the secrets behind Lovesac's innovative design for life philosophy, and practical insights for entrepreneurs and business owners. Whether you're starting a business or scaling for growth, get inspired by stories of resilience, creativity, and relentless ambition. So definitely check out Sean Nelson's interview. It was quite interesting. It was funny because the funny part about that, if you're watching the podcast, I did not know who he was before I interviewed him, and I've never sat on a Lovesac furniture. So it really was me learning for the first time about this, thing. And then now I talk to people like, oh yeah, the beanbag. I love that thing. Everyone's got one, it seems like. So it's kind of crazy. Preferred listings. We do have some preferred listings. Let's go with 12707 Sinbay Court in Jacksonville, Florida. We have a 4-bed, 3-bath, going for $388,000. Contact Charday Nix 904-520-8041. And then what Vince is referencing is 2602 Hummingbird Lane in Humboldt, Texas. It's a
Aw.
3-bed, 2-bath, going for 284,444. So it's trying to stick out there. 284,444. Contact Carolyn Jones, CJ. She likes to be called CJ. CJ Jones, 281-356-0203. We have 4634 Deepwood Court in Bowie, Maryland. It's a 3-bed, 2-bath, going for 367.5. Contact Phil Dyson, 443-280-1842. We also have 412 North Ridgeland Avenue, Elmhurst, Illinois. It's a 3-bed, 1-bath, single family, going for 410,000. Contact Laretha Lowry, 708-670-8165. And we got 2030 East 72nd Place, Unit 3D. It's a Chicago condo investment opportunity going for 99,000, 2-bed, 1-bath. Contact Evelyn Wood, 773-718-9742. All these preferred listings are on my website, www.danteroyster.com. So I have more preferred listings there. So check them out, and hopefully we can get you pre-approved and get you a house. Jess, why don't you pass out that contact information?
Ooh, Jess Ford's contact information is okay. So you can find me on the Instagram at jford_consulting. If you Google Jess Ford loan officer, I'm gonna come up. You'll find my link tree, my Facebook, the website. Direct contact information though. If you want to call or text me and you have questions, or maybe you need a pre-approval or a refinance, 313-673-6108.
Awesome. And Vince?
Everyone knows my contact. I got to throw a question to Jess.
What's up?
So you here now with us for your first 30 days, right?
Mhm.
From transferring roughly thereabout.
Yeah.
I know
roughly.
Dante don't like to talk about this, but what's been one of your pleasant transitions?
I don't understand the question. What do you mean?
Putting you on the spot.
Yeah, I'm putting you on the spot.
I really don't understand the question.
So what has Epic done to make your transition easier from where you were, or what has it like been easier for you?
Okay, so to preface this, right, I come from a shop of friends. Like, we've been friends for decades. We worked at all the same companies together. So Dante was up against a high bar, and he definitely jumped over it. Like, he's so responsive, and I love that you don't get annoyed. Maybe you do, but you don't show it. I never know. He's made it like very welcoming, very much a smooth transition, and compliments. And he's not complimenting me all the time, so it feels fake. It's just like every now and then he's like, "High five, Jay Ford."
Wow.
So I think just his demeanor altogether. Like, Dante, we've worked together in a broker AE relationship, but in a broker loan officer relationship. Good job, dude. And I feel like I made a good choice, so I'm gonna high five myself.
There you go.
Crazy. Did not know that was coming at all. Appreciate you, Jay Ford. Appreciate you, Vince. Crazy. We do have questions, though. People are responding to us and wanting to hear us. We got about 413 people listening. So appreciate everyone. And if you have questions, put them in the comments. So let's kick it going. What we got? Damien here. This breakdown made complex finance sound simple. We try to keep it simple. Everything.
Yay.
KISS, right? KISS. Keep it simple, stupid. All right, Joey. So if the Fed raises rates again, how soon would that hit mortgage rates? Good question, Joey.
Well, they're not going to raise rates again. I mean, they're going to do nothing, or they're going to cut.
Correct.
And that's going to be the concept for the next year.
Correct. For the foreseeable future, really.
Unless something drastically happens to the economy.
Correct.
Yes. And I want to add on to that, because this doesn't get said enough. So it's not that rates are necessarily shooting up and down. Joey, what you see, and if you're talking to a loan officer, is there's a cost to a rate. Every rate either pays you back a credit to go towards your closing costs, or it costs you something. Usually the lower you go in rate, the more it's going to cost you. The higher you go, the more you get back. So rates can be the same every day, but their pricing is going to be different. That's what we need everybody to understand. That's a huge piece of the puzzle. I have a client that I'm working with right now. Pricing was wonderful. She just wanted to talk to her husband, and I let it go because 10 minutes, cool, go talk to your husband. He's there in the house. In that 10 minutes, pricing changed and her cost went up $6,000.
Mm,
Rate didn't change, but the cost of the rate did. And
sure.
that's a big deal.
That thing called margin that the consumer doesn't see.
Yep.
Correct. Good point. All right. Next, Nick, why do mortgage rates sometimes drop even when the Fed hike? You want to take that, Vince?
I mean, that's going to deal more in an economic situation when that actually happens. So, I mean, you got other factors that come into that: consumer spending, what unemployment looks like. There's too many other factors because that doesn't happen often. Like, it has to be drastic.
I mean, the Fed's job is to protect the American economy from inflation and from unemployment.
Right.
And it's a juggling act between the two of them. And so, obviously, if inflation becomes hot, where things are becoming more and more expensive, the Fed will go ahead and increase interest rates to slow down people's consummation,
Consuming, yeah.
consuming. So the consumption levels, if they get too high, they raise rates to kind of slow everyone down. Hey, stop buying all these resources. But if people are losing their jobs and we're seeing a spike in unemployment, if that's going to be because of the government shutdown or what have you, then you're going to see rates have to, be reduced. So there is a juggling. There you go. That's 6-7 right there. 6-7. That's your juggling that that the Fed have to do. And that's the hard part of their job, is to really assess the data, assess the reports, and then make a decision. Some people are hawkish, some people are dovish, which basically means some people think, hey, we should just raise rates, or some people look at the information and it's based on interpretation. And that's why we listen to them, and they're not really a part of the government. They're kind of their own separate entity, so that they are not persuaded by one side of the aisle or not. So it really kind of, that's one of those situations. So right now, we've had a lot of job loss. We've seen big companies letting go of people, with job layoffs. And so that has been the spearhead, so to speak, to say, hey, we need to lower these interest rates.
Yeah. I mean, I want to say that one other thing we said earlier too, we left rates too low for too long.
Yep.
Right. So that causes a little bit of an issue of where we're at. And, we'll say this, we haven't had a recession in a while. We don't plan on having one, but the Fed is trying to do its best to avoid one. And I mean, if we get into it, we're in a recession when it comes to housing. There's not enough activity. And in 2026, the whole point of this is to increase activity.
Trying to avoid a recession and stagnation at the same time is not an easy feat, especially when you're talking about an entire country.
Yeah, the reality, and we've talked about this, is just, our industry, just real estate, right? The real estate industry is really the backbone of the U.S. economy. When one transaction happens, we impact with our ripples, 7 to 8 different industries. A one transaction today, someone that's closing on a house today will, need new furniture, will need, to do some home repairs, will need to move, will obviously the closing. So you got real estate, banks, title companies,
buy new appliances.
New appliances. I mean, so literally you're talking about 8 to 9 to even 10 industries that are impacted off one single closing. And so the activity that Vince is speaking of is so important for the American economy. And that's where, if we can unlock this, if we can unlock and somehow find a way to encourage people to get out there and buy and invest and do all those great things, the market will, obviously will be rewarded. And so that's what they're trying to do. And they figure the best way to do that, because we've seen such a spike in prices, is to lower the rates to kind of offset the spike in prices that we've seen. Does Wall Street usually react before or after the Fed makes a move? Before.
Yeah.
Before. We are inside information. we are leaning on anything Jerome Powell and company are going to say. We are, probably have some microphones that they don't even know about. We want to know before they even do it. I mean, that's how we know when the quarter point is going to happen. We already have, a whole thermostat telling us what time it is, what's the probability. We need to know before, and then the market is going to move.
I've never seen Jerome Powell be so popular, by the way. Like, there are so many people who know who he is that just normally would not. It is. I love it. I love it. There's a lady I follow on Instagram. She's great, but when she refers to him, she refers to him as the Fed Daddy, and she has these episodes about, okay, so here's what the Fed Daddy did today, and it's hilarious because he's kind of just leading us all around.
They did a meme with the Fed Daddy at a concert, and that was hilarious. That was hilarious. So no, it's important for consumers to start knowing who are the players, because they impact our lives. So you should know who Janet Yellen was, or Ben Bernanke, or these Alan Greenspan. Obviously, we need to know who these people are, because they are impacting our lives. We need to know how these things work, because it's so important. What's the smartest move for buyers when rates fluctuate like this? Get locked in.
Locked in.
I saw this one earlier when I was glancing over at the question. So obviously, if you're buying a home today, when you talk about this fluctuation, what is that difference? Are you talking a quarter of a point, an eighth of a point from what it was previously? Again, when you're buying a house, it's not about the rate. It's the timing of your life that it's time to buy a home. The rate's kind of irrelevant. And I say that from the standpoint not to be ignorant to higher interest rates, or someone not giving you the competitive rate that you deserve, or whatever it is in the industry. You're going to have 30 years to try and reduce it.
Right.
30 years, 30 chances.
Right. Focal point that people think it is. It's very much secondary in that particular situation.
Correct. Because the first thing is you want to have the house. You want to buy the home, right? There's other ways to lower the rates. We could talk about buy downs. You could pay points. You can do a bunch of different things. We could work concessions into the deal. It's the timing, right? The rate fluctuation should not stop you from buying the house. Because if it is, you should have already locked in your rate.
Going on a tangent on that, that's funny that you bring that out, because, this 40-20 split that we talked about last week really had me stuck in my head. And for Jess, just to keep you up to speed, I kind of stumbled on the idea, maybe just all the information coming into my head, is this concept that we basically put 40 years, we kind of we didn't even agree to it. We get stuck with, you're going to have to work for 40 years to get 20 years of retirement.
Oh, yeah.
You know what I mean? And so it was just kind of like how the numbers kind of finally got it's a 40-20 split. I mean, so kudos to the Gen Zers and the millennials of the world that are trying to push and say, forget that. We got to do better. We got to make it 30-30, or there you go, trying to figure that stuff out. Yeah. Hey, I got to figure this out. Yeah. But it is a hard thing, because, in my head, I was like, okay, if you're in your 20s right now, you could get extra credit in life and maybe start a career early, right? But most, generally, just based on the numbers, are still kind of floundering in their 20s, trying to figure out, who am I? Where am I? How do I exist in the world? And then once they hit their 30s, then maybe they start, okay, I think I kind of know what I want to be when I grow up, maybe. And then I start getting a job. And then, because we know that the average first-time home buyer is 38 years old. So he's been living in, mom or dad's basement, or he's been renting an apartment. I talked to, I went to, there's a local ice cream shop around here, and I'm like, man, how old are you? I mean, just because when I was a kid, at those types of, venues, it was 16-year-olds, 17-year-olds, that were working those jobs. I worked at
Mhm.
Blockbuster. I worked at Oberweis Dairy. I was just a young kid, looking to make money. Now you have like grown up, like, man, I'm 27 working at an ice cream store, and I'm just like, okay, wow. I mean, is there a management position going to be coming up your way? I mean, is there any, where's the growth at working at an ice cream shop? Are you the cousin or the family? Is that your father or mother that owns the place?
Right.
No,
But no, but that's because you're still, mom and dad are still okay with you living in the basement.
correct.
Depending on what generation mom and dad came from, because and this is, you guys can look this up.
Jess was
Millennials,
giving us the finger point, Dante. Just,
you
just,
guys,
just so you know, she
like,
was giving
hey,
us the finger. Well, she was giving it to me, right? Not to you. She was giving it to
so
me.
many people,
Oh,
like
baby.
millennials,
Hold on.
we get hated on so much. It's gonna depend. So like millennials are a very frequent and significant subject group. Like we have been tested on like lab rats, whether it be social science, psychology, market research. So if it's us raising those kids that are, 22 working at an ice cream shop, yep, chances are they are a little behind because we're still trying to figure it out. But
Sure.
if it's one of your children from your generation, right, and we are just a breath apart, it was still different. And they probably, your kids are probably a little more, now I don't want to say well-rounded, but they are maybe a half a step ahead, you know? It's it kind of, it just depends on the generational divide. Like I, now that we have so much data on what happened to us as millennials, like it's very eye-opening.
I want to
Yeah.
take this conversation and go 10 years later. Let's see what the kids that went through high school during COVID actually look like when they
Oh,
get out of college age, right?
listen, they're a mess now. The
Yeah.
COVID babies, the COVID dogs are weird. But the kids who miss part of high school or their freshman years of college, you can very much tell there is a social adjustment that needs to happen for them to continue to succeed. And just because they're going to be the ones taking care of us and making decisions for us. So like I want them to be better.
Yeah, it's just interesting. I mean, I do look at it from a decade perspective, and you can look at it from a generation perspective. I mean, it's such a huge melting pot right now. I mean, you still have baby boomers working.
Mhm.
Vince and me are Gen X. You're the millennial. We have Gen Z's working. My kids are Gen Alpha, and so it is just fascinating. To your point, as a Gen Xer, where we had to be multifaceted on jobs and roles, so
Mhm.
that expectation is being pushed on the Gen Alphas. That
Yeah, you
hey,
guys are cutthroat.
you got to be able to do everything, because just even in the hiring process, right? I've had a hire recently, and when I'm hiring or at least interviewing, it's fascinating. Everyone's a specialist that's a millennial or a Gen Zer. They don't have the capability of being really well rounded. I can do this, I can do that. I'm really good at this, but this is all I know. And just noticing that, like there's so much, our age group, you played football, baseball, and basketball. You didn't just, oh, I no, all I do is baseball all year round. All I do is basketball all year round. There's such a specialist type of mindset. Maybe it's because the money is so big in certain industries where it's like, hey, this is all you need to focus on. But that, you used to do multiple
Could be.
things.
So I that could be it. I think another big part of it is when you guys were in college, right? You guys were the last generation guaranteed to leave college and have a job. Whereas millennials came in right after you and it was, okay, you can get the degree, but you don't have any experience. So go work at an ice cream parlor until you do. So while we were in school, we had to figure out that one thing to hone in on and get the experience just so that we could get the job once the degree was done because by then it was it was oversaturated for the most part. You guys were not retiring. You were too young to retire. You weren't going anywhere anytime soon. So the competition became really tough and oversaturated. So we had to focus in on that one thing, and then hopefully we'd be able to branch out to something different later once we got the degree and the job. It's just a really weird time.
It really is.
It was very frustrating. You can't have the job if you don't have the degree, but you can't have the degree if you don't have the job.
Well, yeah. I mean, when I came out, and this was 2002, that was kind of the scenario was starting to turn.
It was starting. Yep.
Yeah, because it was like, well, I want to do, I went to school to be a marketing agent. I wanted to be Darren Stevens from Bewitched. Now I'm opening up the cupboard and really let you know what time it is. I wanted to be Darren Stevens from Bewitched. Now this is truthful. And so I'm going out there looking for a job, and they say, well, you need to have 3 to 4 years of experience.
Mhm.
Well, how the hell am I supposed to have 3, 4 years of experience if I can't get the?
That
Can I
is
get a job?
exactly what I'm talking about.
Yes, yes.
Exactly what I'm talking about.
So then they want to put you entry level sales and being door knockers. And I'm like, man, I went to school. I didn't know. How do I go to school and get a degree? And you got me trying to door knock, Nicor gas. Like, what are we doing here? No, I'm not doing that. So it is fascinating. Let's finish up some of these questions. Matt, does a Fed pause signal opportunity or caution for investors?
Short term, yeah.
Short-term opportunity.
Yeah.
Yeah, if a Fed, yeah, that's all. I mean, there's, that's the thing. There's so much. The reality is, you have to have the mindset. There's always opportunities out there. You have to just be able to understand them and see them and then execute. Because we've talked about, I have a client that did a fix and flip. She bought a house in 2024. Last year, she bought a house. She fixed it up and she sold it in September, and she made $175,000. Now, for some people out there right now, you can't fathom that. No way. In this market, with the prices so high, how are you able to find something that was so cheap and you were able to sell it?
That price was a little bit lower, right?
No, 24, my fault. So last year she bought it. I think she bought it for $130,000. She put about $60,000 into it and sold it for, $375,000. So it's still possible. Opportunities, especially in metropolitan areas like where Jess lives, where we live, there's tons of opportunities. You just have to have the knowledge, the wisdom, the right team around you to support you. And there's opportunities where you can take advantage and exceed. So don't limit yourself. So there's always opportunities. And I think investors know that. And that's why people are buying. I mean, the whole, I had Ari Rastegar on Monday, and he was talking about just his whole buying up Dallas. He was buying up all of Dallas because he's looking for the migration to come from New York based on what happened last night, right? We got the new mayor of New York, and some people are not going to stick around to wait to see what can he do or what can he do. They're going to just, exit stage left. And so he says, come on down to Dallas, Texas. Come on, y'all. But, and that's his choice, and that's what people's choices are.
Side note, Detroit got our first female mayor last night.
Whoa. What's her name?
Mary Shutfield. We went to school together.
Wow, small world.
Yeah. It was a small school too, so it made it really weird. There were only like 20 of us.
Jeez.
It was 200 in the whole school between kindergarten and through 12th grade. So yeah, small world, small school. Jeez. But yeah, shout out to Mary Shutfield, first female mayor of Detroit.
We'll see how that goes.
A millennial.
Uh-oh. And then John Morris, and then a mortgage-backed securities will really outpace the Fed's influence. I don't know. And
if they keep buying them.
Oh, it should be.
It can.
Okay.
Can mortgage-backed securities really outpace the Fed's influence? I don't know. I don't think so, because the Fed is the one that decides if they're going to, continue to buy mortgage-backed securities.
Right. And mortgage-backed securities compete with a different product. And they're created you have to remember that mortgage-backed securities are not individuals. They're bundled.
CDOs.
Yeah.
CDOs.
They're created in a bundle. slightly higher risk. I mean, no, not the Fed's influence. Other parts of the economy, yes, but nothing's ever really gonna outrun the Fed.
Fed runs it. So it'll be interesting to see as we they got one more meeting. They do got one more meeting.
Yeah, we shall see. Dante, I've been thinking about your theory coming up next week about whether the government's going to reopen based on the military getting paid or not. That's going to be next week is going to be very interesting.
It will be. It will be. I mean, government shutdown is I think we broke a record, right? I think
We
it's
did.
official. Yeah, it's the
Yeah, we did.
longest ever. Hey, the man is going to break records. He's going to do things that no one's ever done before. That is the bottom
tell
line.
no lies. You tell
That's
no
the bottom
lies.
Let's not break a record. Let's end the show. We're at an hour marker. We're good.
We did. No, I appreciate you guys for being on. I had fun today just talking to you. And I want to go back to that 40-20 split, and we'll continue the generational conversation on next time we get together. Because
30-30 ESPN special, 30-30.
There you go. I think it's interesting. I think it's a topic. It's basically redefining the American dream, and I think it's something that I'm really keen on having those conversations and thought patterns. And so I appreciate the audience for giving us those types of questions to really like spur our mind. And we learn from you. By you asking us questions, we get more familiar, and it's a good test for us on just what we know. And appreciate everyone listening today. And what we got? So we're back next week. We're back
on Monday to talk the Bears at 6-3 after your visit this Sunday, huh?
They better take care of the business. I'm going to be cold, so they better win because I'll be mad. I'm going to be so cold. Man, so mad on Sunday.
It won't be that bad. You'll be all right.
Or you won't. One or the other.
Bring some alcohol with you. Leave the kids at home and stay warm that way.
I'm going with my buddy. I will bundle up. I will be cold. Hopefully they got that hot cocoa for me, so I'll be ready.
You need something to go with it. You'll be fine. Just pour it in the You may be hungover for the show on Monday. We'll see.
I don't know. We'll see how it goes. I got to get the scarf and protect that neck. I know that.
That's right.
But no, appreciate everybody. I know tomorrow we'll have a new podcast available, so make sure you check out Epic Spotlight. The new podcast will be available tomorrow. So a new guest. It's actually 2 guests, if I remember correctly. So it'll be an interesting one. Took it in a different direction this next one up. So let me know what you guys think about it, what you like. If you like the stuff we were talking about today, make sure you give this a thumbs up. You can always subscribe to the YouTube channel. Really appreciate that. We are on our way trying to get to 5,000 subscribers. That is our goal, 5,000. We're trying to get there, and then we'll work our way to 10. But we'll start off with 5,000 as our next milestone that we're going to celebrate. And then I think we got Randall Avery on Monday, if memory serves me correctly. So that'll be
Randall's coming back.
Oh man, we're gonna roll up the sleeves. We got a debate again, another debate.
Are we gonna drill to understand
that should be fun on
people,
Monday?
Are we gonna hit him up for the whole thing that yes, you got to get out of your 4% interest rate and take cash out of the house? Are we gonna touch on that one?
He could not believe. I mean, literally after the meeting or after our show, he called me. You really tell people to take money out of their house? Is that real? Do you really do that?
Yes. I will make sure I tune in for that one.
Man, he was dumbfounded. He could not believe it. So I was like, yes, we actually take the money out of those walls that you see right behind me. We take the money out of them. We don't let the money just sit there.
The financial tool.
Man, well, you
got to remember he's a financial advisor, so there's a difference, right? His whole point is, and he's a nice guy, welcome on the show all the time. He brings good knowledge. It's just a different way of looking at it, like because financially that is a struggle. Like you're taking my fixed payment of this at such a low rate to go to this, but the concept that when people are in debt, there's no other way out of it but using the equity in your house.
Yeah, he's anti-debt.
Advisors don't see it that way.
I hope this Series 7 doesn't change my mind like that.
Oh, man.
But I'll have the best of both worlds though.
We hope.
Hey.
That test is tough though. I'll tell you that.
Okay, experience. Thank you. All everybody says.
He's speaking from experience.
Got it.
Man.
Goodness.
You got this though. It's the options in the second half of the day.
It is
Man,
literally
that
the
is
options.
hey, I'm gonna man. You want the secret? It's the options in the second half of the first half, easy breezy. That second half, man, you better know those options if you want to pass that series 7.
Yeah,
Oh,
options.
Say that.
I got one last thing, and this is not to dig on who's coming Monday. What?
Randall?
Avery? Randall?
Yep.
He's not only a certified financial planner, he's a certified financial analyst. So he's put a lot of time in to get his series and his certificates.
Oh yeah.
So I just want to put that out there. I'm
The
not, we're not
certified
digging on
financial
him.
planner, nothing to sneeze at.
Correct.
No.
It's not easy.
No, it isn't. It is
Yeah.
not. It humbled me, and you know, I needed that at that time because I thought I could just wing it, and I was like, whoa. Whoa, it's a different animal. But no, appreciate everybody. If you are interested, we have our epic newsletter that comes out Friday at 5 p.m. Central Time. Go to www.danteroyster.com. You can type in your email and you can be a part of our newsletter where we'll further break down the market and just give you some tidbits. Also, we got some you know, ingredients and food of the week and all that good stuff. So everyone have a great weekend. Go Bears. Hopefully they take care of business. I don't know about those Lions. Hopefully they lose again.
Don't be a hater, Dante. Don't be a hater. Just end the show, okay?
I think they'll win. They'll beat the Redskins or Commanders, excuse me. All right, guys. Take care. Have a good weekend.
All right, guys.
Thanks for
Have a
joining
good
us,
one.
Jess. Take care.
All right, bye.
Bye-bye.
Thanks, Vince.
You got